Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler. PaulWinkler.com is the website. I probably should throw that out there from time to time, where there's all kinds of educational material on there. Videos and audio. There are videos on Social Security, how that works, Medicare, how that works. You can watch the webinars on just about any topic. You can do searches for all of these types of things. You don't have to go to these lousy steak dinners. As a matter of fact, I saw an article today talking about how AI would actually screw up all these financial advisors' free dinner workshops, and nothing could be better. What a great use for AI to screw up all these steak dinners that people are actually just getting raked over the coals, in my humble opinion, going out to these things and being sold things that they shouldn't be buying. Not a big fan, if you can tell, at all, of the type of marketing programs that are out there that financial advisors is putting out there. So this is the antidote. This show and my website is the antidote to all of that junk. So back to this. I want to get back to this one article because I didn't feel like I spent quite enough time on it. I just want to hit a couple things that were talked about in this article about teens and how they're investing. And, you know, I made this point about this young lady. She made $500 in a year. She was on board. She's gotten excited. She's invested about $55,000 from the side gigs. And, you know, you look at that and go, is $500 good? Or should she have done way the heck better? This is the problem with this stuff. A lot of people don't know how to benchmark their investments. You have to look at how you did versus what you should have done. John Stossel was brilliant with this. He would throw darts at the stock tables. And every year when he would do this, he would beat the professionals. I don't remember him ever not beating the professionals throwing darts. And I would do the same thing. I would have people throw darts at the stock tables when they came in for our educational sessions here. And here's what would happen is you might have an up year in the market, let's say. And people would throw darts, and you look at their investment portfolio, and their funds made money. They had positive returns. But you'd have them throw darts, and they higher returns than their funds had. And they would sit there looking at you in total shock. How is this happening? What's going on here? And I'll go, well, you thought you were doing okay with that fund, didn't you? Yeah, I thought it was great. Everything, hey, made money. Also, you didn't realize you were losing compared to what you should have made. And they had no idea. Or in down years, losing more than they should have. And these are what we call relative losses. And this is something that people totally miss because they don't know how to benchmark things. So when I'm looking at my investments, I go, okay, what area of the market am I investing in? Large U.S. blend stocks. Okay, let's compare it to a blend index. Where am I investing? Large international blend stocks. Let's compare that to the Europe, Australia, Far East. Small international value stocks. Well, Europe, Australia, Far East, small value. It's investing in emerging market stocks. Well, let's compare that to the MSCI EM index, that area of the market. And this is benchmarking. This is what we want to do. This is how we have confidence that things are going the way they ought to be going. But people aren't taught that. And especially so, back to the stock market game, you have these kids going into school and they want to learn about investing. Matter of fact, there was an article about this. It was in Yahoo Finance. Does the stock market game really teach teens about investing? And I thought this would be a good expository article on this topic. Seems to be a very effective tool, they said. Younger people to really understand how the stock market works by simulating real market transactions, says a certified financial planner. They should know better. It's a good tool to teach people how to do what? How to buy and sell stocks? Which in essence, what you're doing is you're buying it from somebody that all they do all day long. When you buy a stock, you're buying it from a market maker. You're buying it from a computer or market or a physical market maker. And in essence, that's all they do all day long is that they trade that stock. And you're hoping you're getting a deal. But on the other side, you have a very informed person, very informed entity that's basically saying, I don't want to pay too much. When I buy a stock, I don't want to sell it for too little when I sell it to you. So it's really pretty egotistical to believe that I can find these mispricings. So when and of course, as I said, when I'm looking at total market segments, now we see index funds being traded as actively as stocks. You're believing that the entire market segment is overpriced when you are selling it. You're believing the entire market segment is underpriced when you're buying it. It says, part of this article says, this finding transpired in this year's Capitol Hill Challenge, the stock market game annual competition. Student teams manage a hypothetical $100,000 online portfolio of stocks, bonds, mutual funds, impact investments, and cash. Now, how do we determine the winner of this particular contest? Well, returns, right? Well, it says the teens invested approximately a fourth of their portfolio in GameStop stock. These are the people that won. They were given the ability to put 25% of their money in one stock. What is that? It's a huge gamble. It says, so the three students decided to max out their portfolio. Now, what do they say in this article as to, as far as what was this? Was this a good thing or a bad thing? They said it proved to be a wise decision. And that's the problem. You reward people for doing things that are dysfunctional, and you're going to get more dysfunction out of them. That's what you're going to get people to do more of if you reward it. If you tell them, hey, that was wise. Well, I want to be wise. Let's invest in individual stocks. Let's gamble with the money because apparently that's wise. According to these adults, it is. And adults know everything, right? It's one thing to explain the benefits of investing to children, but if they don't ultimately see actual results, they'll lose interest fast. That's one person they're interviewing for the article. In other words, if I don't get fast gains, this investing's a waste of time. Now, the reality of it is that investing is anything but fast. Lifelong discipline is what I'm shooting for, and that's not fast. Having them start young and keep score. I say this.
I was going to ask you that.
What's that, man?
No, I was going to ask you that fast gains.
Well, so if you look back to the 19th, I kiddingly say this to people, but the numbers are real. If I say, you don't know how many people had $100,000 in the 1970s that don't have $60 million today.
What do you mean?
They'd be like, what? And I go, that is market returns. If you're diversified between large, small, large value, small value, international, large, international, small, international, large value, international, small value, emerging markets, all these different asset categories, and you just capture market returns. But how many people have results that are so short of that? And the reason comes down to that, and I hate giving number examples like that because it's just
no.
Because it blows people's minds.
Keep it going.
But here's the thing, is that people have results that are far short of that because they approach investing as a gambling casino. Buy, sell, which stock, which area of the market, what should I be doing right now? What's going on in Russia? What's going on in Ukraine? What's happening in China? What's going to happen with the U.S. government? What's going to happen with the federal debt? How's the debt going to affect the stock market? That's what we typically look at. And we try to figure out what's going to do well next. And the worst part about it is what younger people are turning to, where they're turning for investment advice. Look at what these people are teaching. And
TikTok.
No, check this one out. Ready? Okay. Here it goes. Here you go.
Before we move on, you do think Hood is a story today, and it's leading the S&P.
Okay, Hood. Robinhood. I guess you don't even have to call it by its full name anymore. You just call it Hood. But look at what Hood is doing right now. Hood.
You said what? What?
He said, look at what Hood is doing right now. He's talking about
what
the
is
stock.
Hood?
Robinhood. It is a trading platform that younger people are investing on right now in droves. This is where younger people are investing. Yeah.
I do think, before we move on, you do think Hood is a story today, and it's leading the S&P.
It's certainly a story in terms of
leading the S&P. So it is a stock that is growing fast in the S&P. Now, they're talking about the company and how well the company's doing. Not necessarily the investors, people that are investing with the company, but the company itself is what they're talking about right here. But check this out. I want you to listen really close.
people, first of all, it had a massive gut check and it went back to August trading levels. But yes, they're making this acquisition, going to sort of be.
What are they buying? What's their acquisition and what are they doing? Are they prudently investing people's money or what are they doing?
Their own market maker for the prediction markets.
They're a market maker for the prediction markets. What a prediction. Who can predict the future? Nobody. What is predicting the future really thought of? When we talk about predicting the future, horse races, we try to predict the future, betting on sports teams or whatever. And well, I'll keep going.
Big story in the Wall Street Journal that's hitting on a lot of the themes I've hit on for a while, which is they've just really skewed their offering toward the most active traders, and they're happy to blur the lines.
They're skewing it to the most active traders, people buying, selling, trading. Think about if I've used this example before. If you're buying and selling, buying and selling, buying and sell, what do you have every time you buy and sell something? A transaction cost. You have bid offer spread costs. You have commissions. Now, in this particular case, you may have an account where you don't have any visible commissions. And you go, well, how's the company making money? And it's the spread cost between what something is bought for and what it's sold for. And that is the market maker. What market maker, what's a market maker, Paul? What is that? They are an entity that makes a market for a particular item. If it's cold medicine we're talking about here, we can go down to Kroger and we can buy cold medicine. We can go to Publix and we can buy cold medicine. We can go to Walmart and we can buy cold medicine. They make a market for cold medicine. When it comes to a stock like Microsoft or GE or Coca-Cola or Home Depot, I have to go to a market maker that makes a market for those stocks. Now, different market makers like Walmart, Kroger, Publix, or Walgreens or whoever, different market makers may charge a different amount for the same thing. Now, let's say that I actually place business with a market maker that marks something up higher than another one. Now I have the potential to make more money as the market maker because maybe I buy it for $3 and I sell it for $4, whereas another entity buys it for $3 and sells it for $3.75. Well, why don't we put the business with the one that marks it up to $4 and take a little bit of that extra 25 cents of profit and pay it back to the person that placed the trade there? Why don't we do that? Now we can make more money, but did you see it as the buyer? Unless you did comparison shopping, which you don't do with stocks. Who goes and comparison shops? You don't. In a split second, nobody's going to go and check different market makers. They're not going to look at that.
Between sports betting and investing in stocks.
So what did he just say there?
Active traders, and they're happy to blur the lines between sports betting and investing in stocks.
Whoa. They're blurring the lines between sports betting and investing in stocks. What is that telling you that they are teaching younger people when it comes to investing? They're teaching them to approach it as gambling.
I think that's where the future is, and they kind of defend it on some level there. So to me, that's interesting, and it means it's a very good barometer of what that cohort's up to on a given day.
Yeah. What that cohort is up to on a given day. And we talked about this with crypto not too long ago. All right, now let me go back and revisit that.
You love, crypto too, but prediction markets are faster new business than crypto?
Fastest growing business we've ever had.
Is it gambling?
Yeah.
Is it gambling?
Yeah.
I don't think it's gambling.
I don't think so.
But
no.
Again, the lines, I think you guys talked about this morning, the lines are getting blurred.
Yeah, there they go, using the same exact line. You notice that, Nick? It's the same exact line. Blurred. The lines are getting blurred between gambling and investing. No wonder. No wonder people get so messed up when it comes to investing. We forget. When we were younger, it's not that different. It was a lot slower, the information we got. But investing has always been approached in this particular manner as a gambling casino. When in reality, I'm buying companies and I should be owning as much, because from my perspective, I want to own tens of thousands of companies. Because I have and I'm not talking about total market funds. Total market funds are just absolutely horrible, in my humble opinion. They're overweighting the very, very big companies. You'll have 30 to 40% of your money in a 3,600 stock portfolio. You'll have 40% of your money in a tiny handful of maybe 10 companies. That's not diversified. But it sounds diversified because they're calling it a total market fund. That's what you see in this target date fund so often. You see that type of stuff. And I just shake my head going, no. That's not good stuff. I've got so much more stuff to get to. I've got to get to a couple of things. There was something on real estate that I thought was really interesting. What's going on in real estate around the country right now? I want to get into that. I want to talk a little bit about copper thieves. Copper thieves are out there in droves. What does that have to do with anything? Well, I'll get into that next. You're listening to the Investor Coaching Show. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, I'm Paul Winkler. paulwinkler.com is the website. We have all kinds of material on the website about financial planning, retirement planning, and, all video, audio, all kinds of stuff. You can even go on there, and if you want to set up a time at any of our offices with any of our folks, we've got 10 offices around Middle Tennessee. 15-minute phone call. You just kick the tires. Hey, what is it you guys do? We're just kind of an unusual financial planning firm. Yeah, we do financial planning. We do asset management. We do all of that stuff, but we don't do it from the perspective of people selling stuff. It is a very, very different thing, and we educate before we ever make recommendations, simply because the more educated you are, the more you understand what you're doing, why you're doing it, what to expect. And, all of those things I think are incredibly important. The more you understand that, the less you worry about this stuff. And a lot of times on this show, I will spend time picking on the investment industry simply because that's where we all came from. Every one of us came from working for big investment firms. And a lot of the stuff that we were taught was just plain wrong. Even getting degrees. I require that everybody be a degreed planner. Matter of fact, that's one of the things that I've been talking with staff about. Is as time goes on, getting junior planners, getting apprentices to come in and learn, because we want to have other people that are like-minded. And if you're a listener to the show and you're getting into the financial planning process, you want to learn more about it, become a certified financial planner, chartered financial consultant. That's your starting point. Those two degrees are starting points, but you got to get into academics. I'm just really adamant that we get into evidence-based research when it comes to investing, because so often you can be any of these designations, you can have any of these degrees, and the approach that you can take can be so far away from evidence-based research that it doesn't make sense to me. It just doesn't make sense. So we educate the advisors as well, but we don't let them loose on the public. All of our offices run by people with more than 20 years experience. I'm adamant that people are very, very well educated before they're ever dealing with anybody's finances. So anyway, that's a quick story about us. More than half of U.S. homes have dropped in value over the last year. More than half of U.S. homes, and nearly all houses in the cities that they've seen losses. They actually go through this. This is a share of U.S. homes that have lost value in the past year. It's highest since the aftermath of the Great Recession, according to Zillow. So homeowners may feel rattled when they see the Zestimate drop. That's how they estimate your value. They call it a Zestimate on Zillow. And it's more common in today's cooler market environment than in recent years. But relatively few are selling at a loss, and that's because real estate had a big market run-up. And what they're calling it is a normalization, not a crash. But here's the thing. There are a lot of people that started looking at real estate and go, man, look at this. Real estate, you can't go wrong. And I would shake my head and go, it's just an asset class. Folks, it's just an asset class. I have videos out there on my website, as a matter of fact, talking about the dangers of getting too focused on real estate. Is this something that you can buy and invest in and have in your portfolio? Yeah, if you like it as a job, and that's the way I look at real estate is as a job. Because you're dealing with buying properties, maybe fixing them up. Do you have that skill? Is that something you can do? Owning them for rental purposes. The rate of return historically of real estate is no higher than the stock market. Matter of fact, when I own stocks, I own lots of companies that own real estate. I have lots of exposure to real estate. But you can have tax law changes. I'll never forget getting in this business in the 80s. And the tax law changes that took place in the late 80s. Oh my goodness, what a mess they made of real estate. People were losing their shirts when it came down to it. They were getting their assets tied up in properties. They were getting their assets tied up in insurance companies that had their assets tied up in properties. Remember that? That was a big deal going on back then. So you got to recognize that it's just an asset class. And it can be something that you have as a job. I have a whole video that I talk about the possible dangers, where let's say the tax rules change in your locality or companies move in or move out. Demand for properties, either it goes up or it goes down. Maybe people start to build properties, and the more they build properties, now you have more supply coming online and the demand isn't there. And then all of a sudden the demand for properties drops and then the price drops and then you can't get it rented out. Maybe you have vacancies. Maybe people mess up your property. You have to make sure that you're taking care of it all the time, as far as making sure the air conditioner works, the roof doesn't leak, and windows don't break, or I could tell you horror stories. I all kinds of horror stories about my parents were into property rental, and my dad was just finally toward the end of his life. He would actually rent the property for a fraction just to keep people in there consistently. And the value that he would get on the property, as far as what a percentage of the property value was very low. And I said, Dad, why are you doing that? He says, because I'm sick of having people move in and move out. I want somebody that's going to be stable and they're going to stay there. And if it's a bargain, they'll stay there. I was like, why don't you just sell the doggone thing? Well, it was up to us kids when we inherited this stuff to sell the whole thing. So that's how that went down. But anyway, so, what we're seeing right now is a normalization is what they're calling it. With demand weak, the housing market has been shifting away from sellers and toward buyers. You have buyer markets, you have seller markets. Pendulum has swung so far the other way that delistings soared this year as sellers became fed up with offers coming in below asking prices, and they just took their homes off the market. So just recognize that real estate is just another asset class, and it can go up and down just like anything else. And the other thing that I thought was interesting before I head to another break here, copper thieves are wreaking havoc across America. So copper thefts have nearly doubled in recent months, 9,770 incidents reported from January to June. Why? Well, so AT&T incurred $76 million in costs over the first 10 months of this year because copper thefts driven by high prices for the metal. And all I could think of is this drive for buying gold, buying gold, buying gold. And, I talked about this, that over in Europe, it has surpassed the euro as the second reserve currency, the second biggest reserve currency in the world. And I said, what does that tell people? That tells you that people see it as a currency. They're not seeing it as an investment. In fact, when I was on Channel 5 earlier I guess it was last month now. Earlier this month. We're still in November. We're still in November. Earlier this month, when I was on Channel 5, we were talking about gold. And I said, do you actually have gold, or do you have euros in your portfolio? No. Do you have yen in your portfolio? No. And we were just going through different types of currencies. And I said, so why would somebody have gold in their portfolio if it's just a currency? I was like, oh, good point. That doesn't make any sense. No, it doesn't. And you think about it, people say, oh, I like gold because it's I can touch it. And I go, well, I can go into, Home Depot and I can touch it. I can go into Cracker Barrel and I can touch it. I can go to Kroger, I can touch it. I can go into an Apple store and I can touch it. I can touch, I actually can walk into these companies that I own a fraction of and I can touch it as well. But one of the things that you really risk is what happens is if the value goes up and all of a sudden people decide to steal your gold or steal your copper. So the thing that people worry about, that, let's say, for some reason, global financial Armageddon takes place, as Evan likes to say, you'd be better off owning, guns and all that kind of thing, rather than some of these objects that people might want to steal. That you'd be better off if you were good at farming in that particular instance. But anyway, I thought it was just interesting to see that copper thieves, they're going in there and they're actually having to try to fight off these people that are prying open manholes, chipping away at asphalt, and climbing trees and poles to cut steel and resell copper. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.